When you're struggling to make money trading, the best thing you can do is make the game easy. How? You take an easy, high win rate scalp trade to get your trading rhythm, flow, and confidence back. This has been a proven technique consistently used by top traders at our firm. And that's exactly what you'll learn from Jeff, head of trader development at our firm, and Garrett, a senior trader at our firm, in this video. I'm Mike Bellafiore, and we're one of the top proprietary trading firms located in New York City since 2005, and proud to have developed numerous 7 and even 8-figure per year traders. Watch, take notes, and learn from 2 professional traders on our trading desk so you can grow your trading account.
We're back, and we're going to talk specifically today about something that a lot of traders will occasionally struggle with, and you'll feel like you just can't get the trade going in your direction. You'll enter a trade and it'll start to work in your favor and then come immediately against you. You'll enter a trade and it'll immediately go against you. You know, you're doing a lot of the right things, but it just feels like you can't get the rhythm, the momentum back on your side. And you can't really get into the flow of the market sometimes. All the traders that we work with go through this. I've gone through it. I'm sure Garrett's gone through it as well. We all have a very specific playbook when we just feel a little out of rhythm with the market. And we're going to share one of those examples. We're even going to talk through exactly what the entry, exit, stop is for that example. And we're going to give a little insight into why we have this high probability trade in our back pocket all the time. So to set the stage for the example, first we're going to talk about why the trade exists. And a lot of times when a trader is struggling, they're probably chasing highs or hitting lows, almost always in a consolidation with an expectation of what's likely to occur versus listening to what is actually happening in the stock. So they're entering a position with an expectation of what might happen, anticipating a break, anticipating a turn, anticipating something. And what you need to do in those moments is just slow yourself down. So really quickly, let's jump right into this setup and into this trade that some of us will use on the desk. And what we're going to do is we're going to pull in the MACD and we're going to pull in some specific settings for the MACD. So a lot of times on our charts, we'll have VWAP and the 9 EMA on. This will be one of those times where you just sense that frustration. And instead of getting up and walking away, or maybe ending the trading day, you just know you need to get a little bit of momentum on your side. So you'll pull up a specific setting in the MACD. We're not going to use standard settings, so we'll talk about that with Garrett in a second. But you'll pull up a specific setting on the MACD, and you'll identify the price action as it's setting up, and then you'll look for this very specific high probability trade. We'll even put a cheat sheet, a link at the end of this so that everybody can kind of take a look and have this as a guide. Maybe this is a good trade for you. Let's jump into the trade. And so what we're looking at is a series of price action, and then we have the MACD on the bottom. And Garrett, a lot of times people will put MACD on their chart. What are like the default settings that come with almost every platform?
All right, so default settings are usually 12, 26, 9, right? So that means that you've got a 12 moving average, a 26 moving average, and then the MACD, which is a moving average of the MACD signal, is 9. So we've kind of modified that here. And the way I like to look at MACD is it's just 2 moving averages. So what 2 moving averages are you trading, right? And then you have a moving average of your MACD line.
The reason why we're using MACD on this specific trade, on this high probability scalp, is simply because what we're looking for is actually a continuation trade. So the MACD is our best friend in this trade because we're looking for that momentum to start and then a little bit of a pause, but then continuation. So we say don't put something on your charts if you don't really understand what it is. So Garrett, talk us through why MACD would be an appropriate indicator to use for a continuation trade.
Yeah, so it's a momentum indicator using moving averages. And what it's measuring is the distance between those moving averages. And that's the MACD line. So if we look on this chart, the black line is the MACD line, right? So when the black line's above that 0, that means that the fast moving average is above the slow moving average, right? It's kind of the definition of an uptrend in some situations. And when it's below the 0 line, that means the fast moving average is below the slow moving average. And then the MACD line itself has its own moving average, right? And that's that red pink line. And so when those cross, you can actually kind of spot turns in the market. That's at least the idea with this. And then the histogram, which is the green and red bars on either side of the zero line, are measuring the distance between the black MACD signal line and its own moving average. And that's sort of giving you the momentum of the momentum. So it's a little bit of a derivative of a indicator kind of added on there.
And so in this trade specifically, we're looking to identify a consolidation period. And we're going to define a consolidation period of at least 3 minutes up to 15 minutes. And we're going to identify it visually by looking at the MACD line. Obviously we can identify it with price, but then we're going to layer on a visual cue of looking at the MACD line. And why do we want the MACD pretty much wrapped around zero in this case?
Yeah, I mean, zero means that the moving averages are converging, right? So that means that things are tightening up on that time frame and energy is being built, right? So when it's at zero, it's neither extended to the upside or extended to the downside. It's kind of locked and loaded. Like if you're looking at a chart with two moving averages and price just starts to kind of go sideways and those moving averages come together and price just starts to kind of hold them, like that's the moment that you're kind of looking for when the MACD hovers around zero.
So this just gives us our trade setup. We don't actually take a trade until we actually have the trigger, which comes in a little bit. But when we're looking through charts, when we're trying to find something because we're just looking for something to work for us on the day, we'll be looking at the MACD, looking for this specific, again, 3 to about 15 minutes of that period of time. And we're using 1 minute bars here, but of that period of time where that MACD is really just kind of wrapped around the zero line. There's not much going on there. And that's our first clue for this trade. So we'll play the chart forward a little bit and we'll talk about kind of what Garrett alluded to, which is what happens when you get that expansion in the MACD, when those two moving averages diverge a little bit. All right, so we're going to see price kind of chop around and then start to make a move. Again, the highest probability trade here, the one that base hit trade that kind of gets us back into the flow and the rhythm of things. It isn't necessarily a trade where we're trading the break of this range. So we're observing the MACD, but we're not sitting there looking for that trade signal quite yet. Again, our entire mindset, and you can practice putting yourself in this mindset of, I just can't get anything right now. The worst thing you can do is actually chase trades around in that circumstance. So we're going to use a very specific setup that occurs. And we just laid out the first step. Let's go into the second step, which is this divergence. So you start to see the MACD start to expand, right? Is that correct?
Yeah, it starts to shoot above the zero line there and they get a little bit spread out from each other. You can see the divergence and then they kind of come back together here.
Yep. And so once you get that divergence and then that convergence and you actually see the fast moving average, is that right? The moving average? Yeah, the fast line move below the slow line. All right. That gives us our setup. Now, all we're looking for is using the MACD as a guide. We're looking for that cross back up like we're seeing right now. As soon as you see that cross back up, you can actually enter long your position and your stop is going to be placed based on price. So your stop is going to be below the low of where that recent little down dip occurred. So our stop is going to go just below that little dip in price action. And what we're going to do is we're going to use the MACD as a guide here. So as long as the fast moving average is above the slow, we're going to stay with our position. We're going to allow that momentum to work for us. And we're going to just hold on to the trade. We're going to let go of the steering wheel here, and we're going to trust that this trade is going to do what it's supposed to do. As soon as we get that cross below, we're going to exit our trade. So again, we've got our stop below the low there. We've entered as soon as that cross occurs, and as soon as we have that dip below, which we just got, that's where we exit our trade. It's a very high probability trade when you get the components right. You see that consolidation first, then you see the expansion, then you see that quick dip back down and then reclaim. That's where you enter your trade, you manage your risk, and you take an exit when you get that cross back below. So again, it's really like a 4-step process, with the first step being we identify that consolidation, second step being we see that move start, right? We can just look at the MACD and see the expansion. Third is we get that cross back down below. And then fourth, we want them both to be above that zero line, but then we want to enter with that trigger when it crosses back above, when that black line crosses back above the red line. So Garrett, can you talk through the settings that we're using on the MACD here?
Yeah, so we're using a 3-9-5. So that's a 3 moving average, 3 period moving average, a 9 period moving average, right? That's what we're measuring, the relationship between those. And we're putting a 5 period moving average on that MACD signal, which is that red line there. So what I love about this trade is that it outlines the execution for us, right? And that's kind of like, I know like when I'm in a slump and when I just want to get some base hits, like that's really what I need. It's just something to kind of, it's like training wheels, right? You just know when to stay in the trade. You know when to get out. You're not wrapped up into the emotion of, this has got to be a huge trade. I need to hold, right? You're just take your profit and run. You guys know I love trailing stops, right? The ATR trailing stop and different things like this. So for me, the way that I would trade this is I would just find a really strong stock. Like that would be one of the number one things is I want to like look at what's active today, look at what's happening, look at what's breaking out, and I want to pick that, right? Or if the Qs or the SPY are having like a really strong day, pick that, gravitate to relative strength, and then look for this setup, and then kind of let the indicator just tell me when to get in and tell me when to get out, and maybe even put it in a model, because that's the kind of stuff you can actually put in a model.
And it takes you out of that anticipatory thought process and it puts you in an opportunistic mindset, which is really the mindset you have to be when you're trading. It's almost like you sit there and you let the trade fall into your lap. Immediately when you pull this indicator up and put it on your chart, you have the settings that you use in it. Immediately your mind, it's almost like a trigger for you. You're just sitting there waiting. You're not trading anything else. You're sitting there and waiting for this opportunity or actively looking for this opportunity. It's a much better mindset to be in when you're trading, of one of opportunity focused versus one of frustration or anticipation or really anything that ultimately boils down to being afraid, right? Being afraid of either a trade not working immediately or whatever. We have very clear rules for this trade. So let's jump into our second example. All right, so again, like Garrett said, we're identifying, in this case, a stock that has been consolidating, but then we watch and we notice how, let's say you pull this up, notice how tight that MACD gets. You have that period of just being wrapped around the zero line. Like it looks like nothing's going on, which is why we don't anticipate this. What if you bought it on the break and you said, oh, I could go now, and then it's stuffed in your face? You don't want to be in that mindset. You want to be allowing that expansion to occur, look for that convergence and that cross, and then enter on that first cross back above. And so we allow that divergence to occur. We let the price start to explore higher, right? And again, we need to make sure that we're just letting this happen for us. We're watching and we're thinking, okay, if this does what we want it to do, then I'll take a trade. But if it doesn't, then I'm just not going to have a trade. I'm not going to invent something. I'm not going to come up with a trade that doesn't exist. I'm just going to wait. And we see now that we have that MACD starting to curl back down, right? But where is it staying? It's staying above the zero line, right? And as long as this cross is occurring above the zero line for a long or below the zero line for a short, this is an important component. Now we have that cross back up, so we enter our position long. Again, our stop gets placed just below the price-based area, right? And then we're staying in the position as long as that MACD continues to diverge. As long as that MACD, the fast moving average, stays above the slow moving average. As soon as those cross back below, we're done with the trade. We're out. That's it. It's just a little high probability scalp just to get us in the trade, let us stay in the trade, right? Feel that feeling of, I'm feeling the flow of the market. This is exactly what trading should be. You're letting go of that need to be, what do I do with price here? You just let the MACD tell you what to do.
From a price action perspective, Jeff, how many times do we see a consolidation like that? It makes a new high and we buy that new high, and then it starts to pull in, right? And you feel uneasy because now it's back inside the range. And ultimately, so many of these end up holding, and going higher. And it's sort of that retest and that go that ends up being where the momentum comes in. And like, I don't know how many times I've been stuck in like, oh, this is breaking out, I'm going to pay the high. Oh no, it's dropping now. I got to hit out. Now, like when we wait for this, we actually have a clear stop, and we're sort of now going to enter when usually the momentum comes in, because a lot of times when these things make a new high, they don't just go right away.
And that's the whole thing is you've by doing this, you simply shift your mindset from that, I hope this works, to now I have another set of checks in my favor. I had that consolidation, I have the expansion, I have that reversal, and then coming back up above. And so this is a really straightforward trade. I love the fact that really to commit to this trade, you have to commit to just following the indicator, because as the volume comes in, as the price action continues to drive higher, you're not anticipating when you're going to sell. You're sitting there and waiting for it to tell you when to sell. When you're struggling, that's exactly what you need. You need something as cookie cutter as you possibly can get. You need very clear rules to follow. And then when you get those rules and you follow those rules, that's where you start to feel that flow back in your trading. And you can start to bring in the other elements of your playbook. But again, we just stay with the trade as long as it tells us to stay with the trade. And then as soon as it tells us to get out, that's when we exit the trade. We have our stop in place. We had our entry based on that. And now we have our exit based on that cross back below.
So Jeff, are you getting out as soon as it crosses mid bar, or are you waiting for that bar to close?
Yeah, so I don't really care, because the entire concept for me is we're seeing expansion. So if it kind of even tests, a lot of time I'm just out. Like I don't need to wait for the bar to close. A lot of times just the test alone. Again, this is just a high probability, confidence boosting, get a base hit sort of trade. It's sort of like if you hit a really good hit and you've been struggling and you get to first base, do you like instantly try and go to second? Like not all the time, right? You just want to get on base. You want to get that momentum going. And so I don't really feel the need to like sit there and say, do I need it to cross or do I need to wait for the close? I can just sit there and some platforms actually won't let you. So you have to kind of wait until it actually closes, but it won't move until it closes. And in that case, it doesn't really matter. The same concept remains. You're not trying to capture everything. You're just trying to get the easy money out of this scalp. Let's go to our third example. In this case, we see price coming off the lows. And this is a really clear example. We'll talk about the setups that you can really look for this trade in, the best setups that we have, that you kind of see those setups, and those are the ones you gravitate towards in a little bit. But this is kind of exactly what we want to highlight, the trade itself. We want to go through one more example. So I'm not trading this breakout. I'm looking for confirmation of the MACD starting to expand. And then I would want to see it start to contract. So I'm giving it time to expand first. As this expansion is occurring, I'm thinking to myself, okay, from a price perspective, what am I risking? If it pulls back, I'm not anticipating how much it's going to pull back. I'm not anticipating where my stop is going to be. I'm allowing all that stuff to come in, but I'm doing these mental calculations. I'm determining what might the low look like here, right? Where might I be putting my stop? That's allowing me to think about the amount of share size I need in order to put the right amount of risk on. A lot of times I'm not risking a lot in this trade simply because, again, I just want to get a win on the board. So right now, this is a little bit of a trick. It looks like, oh, what if the lines go below the zero line? If both of them went below, I wouldn't take the trade. But in this case, the cross occurs completely above. So you can take the trade. You have your very defined stop, right? The stop, again, goes right below the low based on the price action. There you go. And then we're going to allow the MACD to tell us when it's time to exit the position. We don't have to predict. We don't have to anticipate. We can allow the momentum to die and allow the MACD to tell us when to exit the trade.
Again, from a price action perspective, we get a retest of that breakout. and then it holds, right? And like, again, how many times when it's pulling back, if you're really antsy to get into a trade, you're impatient, right? You start bidding in early, or you start paying the offer on those red candles, and you start getting bad prices, and then it goes against you, and you're not waiting for the turn. We always talk about waiting for the turn, right? And one of the ways to do that is to watch the tape, to watch the candle, that big green candle that occurred. But this MACD signal is sort of like, to me, another way to wait for that turn.
Yep. Yeah, you're by definition always trading on the right side of the V, right? You're not letting yourself get caught. If you're waiting for that cross back up, you are, in theory, and as much as you possibly can, trading on the right side of the V with this. So what's tricky about this trade, and why we don't just make this trade all the time, you probably could, but sometimes it varies in your risk to reward. And so when you're looking at your total portfolio of strategies, sometimes you want to add this in and sometimes you want to take it out. Garrett talked about two great situations to take this trade: when something's trending, when something's breaking out of a higher time frame range, when something's consolidating intraday. You can kind of sit back and wait for this to occur. Higher time frame consolidations, big dog consolidations, hitchhiker scalps. You can look for continuation off of those. These are all little setups that you can wait and allow this trade to just hit you between the eyes. You take the trade, you know where your stop is. Again, you're allowing price to determine your stop so you can calculate your share size, but then allowing the momentum to work for you as long as it remains there.
So we're not using the MACD histogram anywhere in this setup, correct?
Correct. I don't think I've ever paid attention to the MACD histogram in this setup. I'm really just focused on the lines. It does, for a long, you want the cross to occur above the zero line. For a short, you want the cross to occur below the zero line. Not just the initial move up, but then that continuation. You want to make sure you're identifying that period of consolidation where that MACD is essentially flat, and ideally flat around the zero line prior to this. Because otherwise you're going to be walking into a situation with too much variability. Garrett, what happens when we're trading this or we're looking for this and we're trying to trade it out of a period of variability? Are we going to get a lot of crosses?
No, we need the energy built up in the trade.
Yeah.
Right?
Yeah.
Like, you can't have it going all over the place. Like right now, we kind of have like that initial move that we traded the pullback for, and then it made another move, right? So we're not going to look now to buy like the next cross, because that whole setup is kind of over.
Yeah.
In my eyes.
Yeah, the whole setup is over. So that's why it's important to just identify this, sit in your seat and wait. We hope this is helpful. Lately, especially with the volatility in the market, we've seen traders go through these amazing periods of growth where they're making really good trades, and then almost as quickly sometimes struggle to just feel that rhythm again. And that can be the big determining factor between how profitable or how successful your week is in trading and your month is how quickly can you get back into that flow as soon as you start to feel out of it. If you do this one time or two times just to start feeling that winning feeling again, to get back into that high probability moment, that could allow you to walk into a really big trade. You have to be in the right mindset when you're trading, and this is just a way to get you back into that mindset really, really quickly. So like we said, there's a cheat sheet associated with it. I'm sure there's a link somewhere. If you want to learn more about the MACD, Garrett has this really awesome video that he did where he talks through another MACD strategy. You can check it out. If you want to learn more about different types of trades, particularly scalp trades or technical trades, Garrett talked about that pullback into that prior support. There's a video that I did recently where we talk through very specific examples. Again, we talk about where your stops go. We talk about where your entry trigger is. We talk about what your target might be. These are just absolutes that you really need to make sure you're understanding. So hope this was helpful.